welcome to a Land Cycle Investor interview. It's so nice to see you. I haven't seen you, well, since our last interview. What have you been up to?
Good to see you once again, Catherine, and nice to be with your audience as well. Yeah, lots of things. I had a bit of an extended break over later December and well and truly into January. So that was the first time I had a decent break like that for about 20 years, I think. So I was happy to have that. It's a good time to have a break over that time because essentially the housing market goes into a bit of a hiatus period for at least the capital cities. So I needed it, and yeah, back here in the office for SQM, getting our data out, doing all the analysis. There's a lot of discussion right now of the opening of the property market once again for 2024, and then of course the imminent Reserve Bank of Australia meeting that's about to occur.
Yeah, obviously I talk about you and your research company a lot to my subscribers. I have you down as the most accurate economic forecaster for annual property price forecasts of anyone else out there. Of course.
They're two kind words, Catherine. I'm only a mortal. I can guarantee I do get it wrong from time to time.
But you haven't got it far wrong over the last few years. In fact, since I've been sort of following your annual boom bust reports, I think since around 2015, I started following them a little bit more avidly than I had been, and you've been pretty spot on, and some of your forecasts have gone in, complete opposite to other forecasts that we've heard where people have been very bearish. You've come out and said, no, property markets are going to recover strongly. When I interviewed you last year around this time, you were talking about Sydney and Perth leading a recovery, and that is precisely what happened. And then I was extremely interested to read your housing boom bust report this year and see something that I've been saying for a while, which was I'll go out on a limb here and say buy Perth. But before I get onto that, because I know you're going to have such a lot to say about the markets and where we are, and I see data coming out from you all the time on Twitter, I want to start off with a bit more of a global perspective, because you've just been on what you said to me, a holiday of a lifetime, something that you're not planning on repeating, and you went on a trip around Europe. And we're in a time where we're seeing a lot of global political tensions. We have the war going on between Russia and Ukraine. We've got war breaking out in the Middle East, and both of those wars are impacting supply lines. And they are, raising concerns that they could spill over into something more. So I'm interested in your take of what it was like on the ground in Europe. And then, maybe we can get into a bit of a discussion about that before we get onto what's going on in the local markets.
No problem. Well, look, yes, keeping in mind I was over there from a tourist perspective, a holidaymaker's perspective. Nevertheless, we certainly did get some insights in terms of what was happening to local people on the ground in Europe. We went to France, the Netherlands, Germany, Austria, the Czech Republic, Italy, and then finished off in Switzerland. And you certainly got an understanding in terms of living standards. Certainly the Swiss have the best living standards, but everything is super expensive, and that's probably not going to be news to a number of your readers there. But I recall buying some McDonald's for our family for dinner, and it came in at 125 Australian dollars for McDonald's in Switzerland, which was very hexy indeed.
And how your family for that?
Say that again.
Well, how many in your family that you?
That was a family of four.
Family of four, okay.
Yeah. So we noticed certainly in the Netherlands a lot of cost-conscious people. We stayed in Airbnbs, and a number of the places had gas regulators within their homes, and as I'm sure you might be aware, gas prices skyrocketed following the outbreak of the Russia-Ukraine war. And it's still very elevated. Now they've come off a bit, but it meant there's a lot of people using gas regulators, just minimizing their use of gas over there as a way to try and make ends meet. So that was occurring. But yeah, look, overall, it was definitely a great trip. I would only recommend for those people who are contemplating a trip to Europe, do it in winter. There's less crowds. far less crowds. We could literally walk up to some of these iconic places, such as St. Mark's Tower in Venice, and we just walk straight in. Whereas if you go to Venice or go to these areas in summertime, it is just completely overcrowded. You will not get great service. And I don't know whether we would have enjoyed our time as much. Yes, it was cold, but hey, you rugged up and it was okay.
Yeah, I obviously, being from England, I've done a lot of traveling around Europe in my time, and yeah, it's always been during summer when there have been a lot of crowds. So you went to the Netherlands. Obviously, cost of living pressures, housing markets are very expensive in those countries. Was it Amsterdam where you went?
Yes, one of the cities was Amsterdam. Amsterdam real estate's always been very expensive. I'm sure you're well aware of that, but no great and huge movements in dwelling prices. So it's been a relatively stable market for some time now. But they've had the rental crisis that we've been experiencing here in Australia. That is certainly not unique to Australia. That's been occurring in Europe as well, due to some population expansion. So there's been shortages across the world, and this is something I think we raised back in 21, that look, what happened post-COVID was a global wave where interest rates fell across the board. People were looking for tangible assets as a bit of a protection against inflation, and that certainly did push up some prices. And rents certainly have gone up in most of the developed world.
It's almost as if the global markets are becoming a little bit more synchronized now compared to what they used to be. Obviously we also have the ability to travel a lot easier than we used to, and yeah, COVID did cause all those disruptions, and obviously the stimulus payments that came out from government were enormous globally, and that has fed into the real estate market being the only market that is short in supply, an accessible supply. And we all need real estate, whether we're renters or whether we're buyers. And so that was going to have an impact on those markets. And as you say, we're still experiencing that. And obviously we're experiencing that in Australia. But just before we move on from that, did you sense that there was worries about, I mean, you went obviously after a war had broken out in the Middle East. I've done a few videos with my subscribers, done a few posts, and I did a video interview with global forecaster David Murrin, who has his finger very much on the pulse when it comes to forecasts about what might happen to these regional wars and whether they'll spill over. Did you get a sense on the ground of concerns, heightened tensions, protests, for example?
Not so much. When we were there, we did not see direct protests. I saw one protest in Paris, which wasn't overly huge. More, I had the sense about concerns when I was speaking to local shopkeepers about the slowdown in the economy. And especially after the peak Christmas New Year period, that basically I had a number of shopkeepers say to me, it's extraordinarily quiet, more quieter than normal for that post-Christmas period. So there was just more concern surrounding the economy from what I could see. That's very anecdotal, of course. I was well aware after we immediately left Germany and would touch wood, we didn't cop this. It was a general train strike. Of course, since my trip, there's been more strikes by farmers, in particular, in a number of countries, and that seems to be spreading. There has been increased angst, and we did see it directly surrounding immigration levels as well. So, you wouldn't say Europe's in a great place right now. It could be a lot worse. Unemployment levels are still relatively low. The concern is if they rise. Talk of war was very heavy in the media, very heavy. I didn't hear so much about it on the ground. As mentioned, the focus was more about the economy. But definitely all the various media channels were covering certainly the Israeli-Hamas war, talking a little bit about what's going on in Ukraine as well. But yeah, more the focus of the Middle East tensions.
We're fairly isolated from this in Australia. It doesn't really impact us. I think we're isolated from it from a news perspective as well. It doesn't seem to dominate the news like it does in Europe.
Yeah, I mean, look, it's there or thereabouts in our news, of course. You'll find a lot on social media about it, but over on the mainstream media, it's there all the time.
And to some extent we're the lucky country, because obviously there's a commodity boom and a demand for commodities, which is very supportive to Australia. We're isolated to what's happening in Europe, and at the moment what's happening in the Middle East. I guess there's supply problems, and also I know that there's the Panama Canal is going through some issues as well. I think that they're saying that climate change has affected the water levels in the Panama Canal, and that they've had to slow the number of boats that are going through. And so all of these things, they have potential to spill over to us, but ultimately they're very inflationary. And with labour markets still tight in Australia, with the cost of building materials not really lowering considerably, we have shortages. So that means that we're likely to continue to see rental markets being tight and constrained, particularly in city markets where that population is coming in. Well, from where I'm looking at, and also the cycles that I'm looking at, I wouldn't be calling for interest rates to be reducing anytime soon. And yet that seems to have been a story that has not only captured media attention, but also the buyers that I talk to. I've got a lot of buyers that are coming on board at the moment thinking that rates are going to drop. I'm interested in your opinion.
Yeah, I'm with you, Cashmore. I think the media's got ahead of itself. And I'm concerned that, okay, if you're a buyer today thinking that interest rates are about to be cut, I'd be very cautious about that. We're about to, as of today, we're about to have the first Reserve Bank meeting, and I'm reasonably sure the RBA is going to put a bit of a dampener on that talk when we see the statement come through. I'm very sure about it. The last thing the Reserve Bank of Australia wants is an acceleration in the economy right now. They're still battling inflation. They have been winning the war, but the war is not won yet. And we know, of course, being very close to the housing market, and particularly the rental market, the rents across the country, this is market rents, are still rising. And it's still rising in terms of asking rents at double-digit levels. That will continue to feed through into the CPI basket, making the RBA's job quite tough over the course of 2024 to get the inflation rate back towards 3%.
And I've had a few clients that have bought in regional locations. They bought in regional locations following the COVID exodus from the cities. So they moved into those areas. They expected those areas were going to continue to perform quite well. In Victoria, we also had the news around that time that the Commonwealth Games was going to be taking place in regions of Victoria, and that would have brought some putting those places on the map, a little bit of attention around them, and also, good prospects for continued population growth. Now we're seeing a bit of a softening in those areas and a softening in rental prices in those regions. Is the boom over for regions?
Last year, I believe that the boom was over, and it did soften, as you say, across most regions. Rental vacancy rates rose, housing prices in a number of these regions eased off, and we shouldn't be overly surprised by that. There has been a movement back from the regional townships towards the capital cities, following return to office orders from employers. However, I got to say that towards the end of the year, we noticed that some of these regions started recording tightening rental vacancy rates once again. So I think it's a watch this space. These are areas long term where Australia does need to expand into. If we're going to continue to grow our population at the current rates, regional centres have got to be instrumental in that for it to be sustainable. So I am a great believer long-term in regional townships, notwithstanding the short-term risks for housing investors, that these areas can be real boom-bust towns. And when they go into bust, there's hardly any liquidity. They are towns which, in my personal opinion, it's not the first investment property you would buy into. It's something you would buy as part of an existing portfolio you would already have, which just mitigates worst case scenarios that if you buy at the very top of the market, you won't get it smashed if that's just one property in your portfolio.
Interesting, a couple of points that you brought up there, because obviously as city rents increase, we would probably get an overflow going back to the regions or people looking a little bit further afield for rental accommodation. But I'm interested in what's also going on in the commercial markets, and this obviously impacts the REITs as well. Talk of interest rates coming down is a little bit bullish for that sector. That sector hasn't gone very far over the past year. We've seen depressed prices, and obviously some of that would have been to do with office vacancies as well, which is a big part of exposure to REITs. In the US, commercial markets have suffered very badly, and the predominant sector that's in the news is the office sector, because in America obviously was impacted by COVID a lot more, and that just hasn't returned to normal, and there's a massive overhang of vacancies. However, it's not impacting all sectors of the commercial market in America. I think that for mega sites, for IT, for the new age of AI, they need very large sites. There's a shortage of very large sites for that sector, for the new age of electric cars and for factories and manufacturing. So there are other areas of the commercial market in the US that are performing okay. But let's bring it back to here, because REITs haven't gone very far. If we have got to a point where interest rates aren't going to be hiked up anymore, maybe we're at a period of time where we're going to see them paused. I do a lot of interviews with Warren Ebbett, who runs Centennial Fund for commercial property, and he is of the opinion very strongly that people are going to be returning to the office. And he actually has started to invest in Melbourne office stock. He's bought a building in Melbourne. So, there's kind of like opposing stories. You follow the equity market, you follow the REIT market. Tell us, what are the opportunities there? Are we starting to see seeds of growth? Is it the time to step in? And if so, where?
For the here and now in the Australian commercial property market, the office sector is front and center in terms of concern. There's no question about that. And for the here and now, office rental vacancy rates are definitely elevated across the country. Sydney and Melbourne are recording rental vacancy rates in excess of 11%. Some other cities even more. They remain elevated. There are pockets which are still doing okay. So your absolute prime, with offices trying to focus on net zero, are still recording tight vacancy rates and actual increases in net effective rents. But everything else is quite loose indeed. Now, I do agree that there are more and more people returning to work more than just say 1 day a week, 2 days a week, 3 days a week. I think they're coming back towards 4 days a week, 5 days a week, because fundamentally, if you are looking to have an office and having employees collaborate physically, that's what is required, more frequency together to make that dynamic work. And so there is that return. We are seeing it through the traffic stats in Sydney, at least. But nevertheless, as it currently stands, we still have elevated vacancy, quite elevated vacancy. Now, when we look at pricing, very interesting indeed, because the valuers in the Australian office market have lifted the measure of valuation, which is ultimately what we call capitalisation rates or yields, into their valuations. There was a lift starting at the end of 2022 of about 30 to 40 basis points. Another lift mid-year 23 of another 30 to 40 basis points. And I think we're about to see the REITs start to report for the 6 months through to December, and we're going to see the valuers once again lift capitalisation rates, and I think by another 30 to 40 basis points. The REIT market itself, listed property trusts, when you look at the pricing compared to net tangible asset backing, they're all trading at discounts. So they're all on the face of it looking like pretty good opportunities. But the problem is that if I am right that we will see another lift in capitalization rates by the valuers, that those NTA calculations, net tangible asset backing calculations, will fall on this current reporting season. I still think that there's some value to be had, and there are some REITs in the office space which have got the right type of properties in their portfolio. And I'm talking about more weighted towards those net zero, absolute prime buildings, and they're still recording some rental increases in their portfolios. So there are some opportunities there, and then there are essentially some value traps that you've got to be very careful of. I would like to remind the audience what happened in the REIT market back in 2008. And I'm not saying for a moment we've got a 2008 period, not at all. But nevertheless, many of those REITs at that time were trading at steep discounts to their net tangible asset backing for fear of the global financial crisis. And what ultimately happened to many of these REITs is that the fund managers, the REIT managers, diluted shareholders' capital. They raised, they did shareholder rights issues, they diluted capital. So on what looked like on the face of it as a great bargain in the REIT wasn't, as it turned out, for the investor, because they were diluted through capital raises to try and get the balance sheet back in order. So that's one thing you've got to be very careful of as a REIT investor.
What about the other sectors, shopping centres? And also, I would have thought that the larger housing companies, development companies are doing pretty well based on, the growth in population. I mean, there's a lot of migrants that are coming in, and migrants, I know that there's areas in Victoria where there's a lot of Indian migrants that go, they go into the new estates. It's cheap.
That's right. Well, look, if you do look at the listed property trusts, listed developers, more focused on residential, there has been a turnaround in unit prices. Stockland, for example, has turned around. Mirvac's turned around, and others have turned around. Others who have had that constant exposure to residential, such as Aspen, well, they've actually had a very good run over the course of 21, 22. They come off a little bit in 23 due to the capitalization rate increases. But since residential rents have been accelerating so much, it's been more than made up for by the rise in distribution yield. So yeah, there's been some interesting plays there. And I think overall, you're right to be a little bit more optimistic about certainly the pipeline of development and the demand for that construction. Keeping in mind, we have certainly still a shortage in this country, and it looks like we are going to build less this year in 2024 than what we built in 2023.
Yeah, let's talk about that a little bit. Record number of construction companies going into administration. It seems to, periodically have been in the news for 12 months and more.
Yes, that's right. These are predominantly small to medium-sized companies, and they ended up getting themselves in trouble because their raw material costs blew out way and above the fixed price costings and contracts they gave to their customers. That was the number one issue. So they were on fixed price contracts to build a new home. Then, of course, we had all the issues in Europe with the Ukraine-Russian war, which blew out a lot of raw material costs. For example, timber costs, which is a key component to building, as I'm sure you're well aware. That blew out at one point with prices rising by over 3,000% for lumber. That's all come back, thankfully, but that huge surge in raw material costs just smashed many small to medium-sized developers who didn't properly budget for those blowout in costs.
The market is absent really still of those small developers. There's a few of them coming back into the market now, and I'm bringing on a few clients myself in my own business that are now looking for land sites to do a development on. So it feels like we're at the beginning of that turn. It kind of felt like that as we were coming to the end of last year. There was sort of some opportunities in that sector, and certainly on the ground, those sites are the ones that look really well priced, because you had anyone that bought an old house on a block of land, a knockdown on a block of land that's not appealing to a home buyer market. Well, they saw a surge sort of during COVID, but, because of what's happened to the development sector, they just have lost money almost. It's almost like they've had no inflation over the last few years when they're trying to market those properties, because there's just not the demand. There's a very small buyer market for them. So, yeah,
right.
you do need to be careful about this, because you can't always foresee. Well, I don't think anybody would have foreseen such massive increases in cost of materials. I mean,
it would have been extraordinarily difficult to budget for it. So it's not entirely all the developer and builders' fault at all for lack of budgeting or foresight that prices potentially for some parts of their materials would rise by 3,000%. That's a bit of a black swan event for them. But it has stabilized. I think the issue now for the construction sector is the elevated interest rate environment. And I think with a number of these developers going bankrupt and making the media coverage for that, would-be new home buyers are very cautious. I mean, who wants to be caught out doing a new home where your builder goes bankrupt? Not a pleasant experience by any stretch of the imagination. So when we look at the forward building approval numbers, they're well and truly down, suggesting to us that when you consider the supply side of the equation in the Australian housing market, it's going to remain tight for some time. The federal government's goal of hitting 1.2 million dwellings being built by, I think, 2028, 2029, well, they're well and truly behind the run rate required as we speak.
Let's just talk a little bit about the Melbourne market in that context. And then I want to sort of look back historically at kind of, periods which are a little bit similar to this one. But, Melbourne market has been hit with really negative news. And I saw a buyer advocacy agency, Simon Presley's agency, last year said, that's it, we're putting a ban on buying in Melbourne because no one liked what Dan Andrews was doing here. He ramped up. He didn't, tinkered around with land tax, so brought more people into the land tax bracket. Obviously people that were running Airbnbs, there was talks about, taxing rents. And I had a few people reach out to me at that time, saying it's almost as if I'm responsible for it because of the work I do at Prosper, because we do a lot of work, with government treasuries, and we're trying to take speculation out of the property market. And they're like, Catherine, what's going on? Like, it's just not worth us being here anymore. And there was, a lot of talk among investors. I had investors that sold because the holding costs became too high. Now, as we start into 2024, the first weekend of auctions went by, last weekend wasn't too bad. There seems to be quite a bit of demand in the market. My personal business is going okay. I'm getting, buyers coming in that want to buy. Is it all done for Melbourne, or do we have some good news?
Well, our forecast for Melbourne for 2024 is that dwelling prices will have a little bit of a mini correction. I think it will be a softer market compared to 2023, but by no stretch of the imagination are we talking about any type of housing price crash, because we have this shortage of real estate. Look, when it comes to over-regulation in the housing market, look, I understand the point of view of why tenants would be annoyed, but I'm also on the factual understanding that whether we like it or not, we've got a market-based rental system. And if you provide disincentive towards property investors to build or to buy, well, that's going to affect the supply side in terms of new supply and indeed existing supply. So it is actually over the medium term, when you want to try and slug property investors, kind of counterproductive if you're trying to resolve a housing shortage issue.
Yeah, absolutely. There's a transition that needs to be taken into account there. And unfortunately, people that work in government that don't work on the ground in the markets and have little industrial experience in the area, they just don't understand these factors. No,
and that's the base. Unless we move to some type of command economy, which sometimes I worry about the state of Victoria. We are going to be with this system for some time. So the solution, of course, is a massive supply side response. Consider, of course, and it's good to see the federal government now realizing that this is an issue, the surge, the absolute explosion we've had in population, and what that does mean for people on the ground in terms of trying to find property. These things need to be considered. But if you're going to lift land tax, if you're going to lift stamp duties, keeping in mind, of course, pretty much all state governments around Australia, the real estate market is, it's the money pit for them. It's how they actually get their budgets back into balance in terms of revenues. And so it's very easy to think, okay, we'll just resolve our massive budget black hole by lifting property taxes. As mentioned, it's really counterproductive to get construction going to increase the supply side.
The other thing I was interested in is obviously, being in this kind of inflationary cycle where we're seeing, building companies being impacted, shortage of property being constructed because of the rise in costs in building materials and, tight labour markets and everything. We've been through not the same, but similar periods, in the lead up to the 1970s correction, early 1970s correction, early 1990s correction. Do you sort of look back at and there were massive infrastructure costs as well at those times, because obviously the governments came out in COVID and said, okay, we're going to build our way out of this, and the huge infrastructure spend, and because now we're in a position where it's unlikely that we're going to be able to, costs are going to blow out, but are we going to be able to complete those those deals? What kind of historical rhyming do you see yourself when you sort of look at this and you're doing your own analysis? Is there
look, very similar to the late 1970s. Keeping in mind, in the early 1970s, or the first half of that decade, we were still having a bit of a building boom following the Menzies supply side era. So that actually stretched right through to the early 1970s. And then due to the rapid inflation rates we were getting in Australia at the time, in 1975, for example, the inflation rate hit, I think it was 17.5% per annum. That created a recession, and you saw construction really slow down. But we were still at the time, very similar to now, getting very strong migration rates coming through. What we didn't have back at that time was heavier taxation on property. So there was less taxation on property in terms of lower stamp duty rates. You still had full negative gearing essentially at that time as well. So it was ultimately easier at the time to go in and to build a new home than what it is now, when you consider all the respective costs.
Yes. The other thing that I highlighted at the beginning of this interview, of course, was in your boom bust report. And, we look around the country, obviously looking at Hobart softening a little bit, Canberra softening, Melbourne and Sydney have had a good year, perhaps not such a good year, and also the tax changes in Melbourne. Meanwhile, over in Perth, and I do a little bit of buying for clients in Perth, and it's a very tight market over there.
It's a very tight market indeed. Our forecast for Perth housing prices was for a rise for this year of between 5 to 9%. It was one of the cities we're more bullish on. And I've got to say, the way that the year's kicked off in Perth, we can see it through stock on market. We can see it through the rents. There's a chance here that we could be underestimating the amount of capital growth one could see in the Perth market. It's certainly my thinking at this point in time is that it's going to come in at the top of our end range there, more towards 9%, if not more.
And you went out on a limb in your report. You put it in bold, I think. I remember it. I'll go out on a limb and say buy Perth for the short term, Perth for the long term. Obviously against affordability in that state as well. Real estate looks remarkably affordable.
It's for value for money. It's you see that the history behind Perth is that for a 10-year period, that housing market did nothing. So essentially between 2008 through to 2018, housing prices actually retreated. The median house price was less in 2018 for Perth than what it was in 2008. So it was this extraordinarily long period of that market just essentially being flat to slightly falling. And that was because over that period, we had a little bit of a commodities downturn following the commodities boom of 2003 through to 2008. And we also had a lot of supply side come through at that time as well. Now, that surplus supply, of course, has now long been absorbed. Perth housing prices have now been rising essentially since 2021. and we think they'll continue to rise. Yet when you look at rental yields, when you look at how Perth housing prices relative to incomes, we're still seeing good value. We're still seeing good value. There are always risks in every respective market. The risk for Perth is that you see an absolute crash in commodity prices, similar to what happened back in the early noughties. I don't think that's coming. I think there's been a little bit of a correction in iron ore prices, but they look very stable now and still at relative elevated levels for the state of WA to keep producing strong economic output. So I think given that long run of underperformance in housing prices making valuations look very good, I think the economic outlook is still quite solid for WA. Yes, I'm a big believer in the short, medium, long term for the city of Perth.
And obviously what drove Perth in that last boom that we saw, sort of into 2008, where I think median prices peaked what they were in Sydney at one point. And a lot of that was, pouring into the mining towns and regional areas as well. And they were the ones that were impacted the most when we saw that crash. I mean, the values just completely were wiped away, really. There was...
Oh, they were. And once again, the caution and major disclaimer about buying the regional townships, that certainly applies to mining townships. I recall, for example, the city of Karratha at one point in time had a median house price north of $1 million. And that came all the way back to, I think it was $350,000. Now, you certainly wouldn't want to be on the wrong side of that type of run.
So that kind of, I don't do any buying in Perth outside of the metro areas, outside of the urban areas. Yep. Perth, I don't go out to regional areas much. That's where I buy, try and stay close to the river, try and stay as close to the bay as I can, try and get something with a decent land component. I don't worry about it as much as I do in Melbourne, because we're more of a subdivision capital in Melbourne, where you've got much more solid population growth throughout all the cycle, right? Because Perth at the moment does have population growth, and you're saying, the risk really, if commodity markets go, is that the population turns around and exits Perth, because if that happens, then you do get that crash, and it's not going to recover until the job market picks up again and the opportunities come again, and then people start to move to Perth. So do you look at the granular data there?
Yeah, look, for Perth, I've generally liked the northern suburbs, northern coastal suburbs of Perth. And particularly, there's a railway line that runs up the coast of Perth there, and there's a number of suburbs surrounding that railway line. And so that is an area that I personally like. I think there's still value to be had to be close to public transport infrastructure. And so not all those coastal suburbs are directly on that railway line. There's a couple of inner suburbs from the coast which are closer. But that's an area which I've always liked to watch.
Yeah, interesting. So, when we're looking around, where are the opportunities elsewhere around the country? I mean, if, you've said, okay, you've highlighted Perth in your report. You said, okay, speculation wise, this is looking great from capital growth. This is, looking great for the short term. It's looking great for the long term. Economies going gangbusters there. Where else would you, to someone, I get a lot of, people saying, well, where else do I buy over the next few years to get some decent capital growth? What would your advice be?
So the next city which we were positive on for 2024 was the city of Brisbane. And our forecast for Brisbane housing prices was that prices would rise between 4 to 8%. Now, we need a little bit more data to come through before we can see exactly how the Brisbane market has opened up for 2024. But that's a city that we are more positive on. Rental vacancy rates have tightened again, are in and around Brisbane. Population growth is still very, very strong. And then, of course, you've got the lead up to the Olympic Games, keeping in mind the amount of infrastructure spend will not be anywhere near as what we had in Sydney for the 2000 Olympics. But still, there is going to be a fair degree of infrastructure spending occurring for the lead up to the Olympics. That's a city that we're more bullish on over the short to medium term, up through to at least the Olympic Games.
Because we normally see Brisbane roll off Sydney, so you get like a good strong run in Sydney. Sydney comes off, and then Brisbane kind of takes the bait and runs off from that.
that has what's happened in the past. So I recall, for example, between 2004 to 2007, the Sydney housing market was underperforming. Actually, in 2004, prices fell a little bit. 2005, it flatlined. 2006, it rose a little bit. Meanwhile, Brisbane was rising at double-digit numbers. In fact, there was 1 year during that period where, if I recall, housing prices rose by nearly 40% in 1 year. So yeah, the two cities are not always positively correlated. They can be negatively correlated unless you have a major macroeconomic event where, for example, if you have aggressive interest rate rises just slamming the overall economy, you would see both cities start to fall and sink. And vice versa, if you were to see aggressive interest rate rises, you would see potentially Brisbane rise and sink with Sydney to an extent. But barring those two events, you see a degree of negative correlation between the two. And that could be well driven, where you have a situation where Sydney housing prices have a run, it becomes super expensive to live in Sydney, and then the community is looking for other places to live, and Brisbane comes up. And so then you see this interstate migration move towards southeast Queensland. Now, when I talk about Brisbane, yep, we're quite positive on Brisbane. We're less positive on the Gold Coast and Sunshine Coast. We are actually a little bit concerned about the run in housing prices which have occurred in those two regions. And so we're just a bit cautious for those two areas.
And when you say you're a little bit cautious for it, what are the indicators that you're looking that flags that there might be problems ahead? Because, where the Southeast Queensland, it's had a lot of population growth over the last few years, in the lead up to the COVID panic, particularly was one of the markets that benefited really from that COVID migration. And as we know, like only a small percentage of people that move to Southeast Queensland go into Brisbane. They head off to the Sunshine Coast, Gold Coast, and the other larger regional towns. What are you seeing? Yeah,
so over the course of 2023, let's talk about the Gold Coast first. Background behind the Gold Coast with COVID was that rental vacancy rates initially spiked in early 2020 up to about 3.7%. So it didn't look too good on the opening of COVID. Then they well and truly came right down as people were looking to get away from the capital cities, and they got down to below 1%. Rents accordingly dramatically rose over the course of 2021, 2022, and the first half of 2023. However, we noted that from mid-2023, rental vacancy rates started to rise again. And yes, they generally do rise on the Gold Coast during the winter periods. In 2022, there was no such rise. So we started seeing the more normal seasonal behavior come through on the Gold Coast. But this was all, of course, in the background of these super rises in rents. And at one point in time, for example, Gold Coast rents for houses and units weekly rents were higher than Sydney. And I don't personally believe that's a sustainable thing you can have for that area, given the fact you see lower income levels compared to Sydney. So I believe that there was going to be a correction of sorts occurring in the Gold Coast market. Rents over later 2023 did flatten out. I got to say, against my information there, over the course of Christmas, they've lifted up again. That could be seasonal. When it comes to prices in the area, I'm just going to bring this up now, and your audience may well be aware we've got a lot of charts online. We have noticed there's been a flattening of prices on the Gold Coast over the course of 2023. That of course, comes after the huge boom where median combined housing prices on the Gold Coast went from about 580,000 in 2020 all the way up to about 900,000 at the start of 2023.
Yeah, very interesting. I mean,
it's a big move, and it just concerns me, Catherine, because the Gold Coast historically has been a bit of a boom bust town. It may not be anymore. But with that type of rise, I think you just need to be a bit cautious.
Yeah, I agree. I mean, people, particularly in the rental market, I mean, people, they move in and then they move out, that's the market that can up and move, not more so than people that own the properties and the supply and the actual accommodation. But yeah, I mean, the other markets obviously that are suffering, Hobart is suffering a little bit. And again, we saw Hobart, it doesn't get huge price appreciation. I think it had like a real burst in around 2004, and then it was pretty flat. This is from my own memory till around 2015, and then I started spruiking it in 2015 actually, and it was based on the Chinese president visit to Hobart, and they were going to extend the airport, and because they wanted a base on the way to exploration in Antarctica, something along those lines. Don't quote me on it because I can't remember all the details. And then it's had like a bit of a stellar run, like into COVID and a little bit beyond. But now you're seeing that come off. You know, beautiful place, obviously. Tasmania.
Yeah, that's right. Well, how you've described what's happening in the market is correct, Catherine. In terms of our data, prices boomed essentially between 2016 through to the end of 2022. Over the course of 2023, housing price growth has really slowed up in Hobart. We've got it up essentially for the last 12 months by about just 1.5%. We also note that stock levels or listing levels have returned back to long-term averages, whereas we had over that same period a shortage of stock, which of course helps drive up prices. So the leading indicators in Hobart are suggesting a softer market. Our forecast that we had for Hobart for 2024 was that prices would fall somewhere between -7% to -3%. So we are a little bit more negative on Hobart. And I think it's a market now which is more sensitive to interest rate movements, given the run up in prices. The value that was there in 2015 is just simply no longer there relative to incomes. Is Hobart a place to consider for the long term? Perhaps it is. Perhaps it is. But for now, the here and now, I think the run has come and it's gone. And we're now in a period for Hobart where prices are likely to be more flatlining to falling.
Interesting. And the other city that's suffering a little bit is Canberra. And of course, you know, I don't really advise property investors to look at Canberra. Part of the reason is because they've done this transition from stamp duty to, well, not land tax, an increase in rates, obviously land taxation. They have different rules around there. The government is the council, so it gives them more energy to do that. From an economic perspective, I think that's fantastic. From a long-term speculation in that area, I mean, how do you see the markets being impacted by those changes in the tax system?
Yeah, the Canberra's had a lot of different sort of policy changes in recent years towards the housing market. Of course, we had the first time owners grant come through. Essentially, it was a bit of a boost in 2022. I've got to say, Canberra tends to be a more trickier market to forecast on because in part that local economy is driven by the various federal government departments which are in place there and whether they're hiring or firing people. And that boils down to the amount of federal government expenditure which is occurring there. Canberra also historically has been a market where you can get a big supply side surge occur in a fairly short time. And we certainly had that following the second half of 2022 and 2023, which meant that rental vacancy rates rose right across 2023, and that put a flat line on rents. It is a city where we're once again a little bit more negative for 2024. Our forecast is that prices will fall between -8% to about -4%.
I would never be forgiven by my subscribers, because I do have some that are in South Australia, if I didn't bring attention to Adelaide and ask you about what's going, because I was just like, when are you going to talk about Adelaide? When are you going to mention it? And I guess, you know, it's my fault, really. It's my bias. It's fallen off the radar for me because, you know, these cities that are smaller by population, they go through these long periods of price stagnation. And then obviously COVID kind of benefited everywhere. And Adelaide's done surprisingly well over the last, you know, few years. Is what we like, isn't there an Adelaide revival? Have we got population growth going into the city? What's happening there? Is that an area that's...
It's a good question. I mean, if we wind back to 2018, where there was some big questions on defence spending, and which, of course, the Adelaide economy it's a reasonably large component of the economy. There was, of course, a pull up of the car industry as well. So things were looking pretty negative in terms of the outlook for the economy in Adelaide back then, but it's ended up being better than expected. in terms of the local economy. Not that we're talking about a booming Adelaide economy by any means, but I think it has surprised many pundits and experts on the upside. Adelaide continues to offer value despite the rises we've had in housing prices in 2021. So the median house price, freestanding house price in Adelaide's now coming up towards about $850,000 for a unit. It's standing at about $432,000. And we've got prices up essentially for the last 12 months by about 11%. So there's been quite a strong run. Rental vacancy rates remain tight, and rents are still rising at a fairly strong clip in Adelaide. In terms of our forecasts for the city, we were more neutral. We believe that we are going to see some house price growth over the course of 2024. We think the price growth is going to be more along the lines of 0 to 3%, but we could be wrong. And if we're going to be wrong, I suspect we'll be wrong in the sense that prices will do better than 0 to 3%.
And then the other market I just wanted to briefly cover, because I do have subscribers here as well, and I've written about it in the past, haven't done much on it recently, and that is New Zealand. Obviously much smaller market compared to Australia, but New Zealand in Auckland in particular.
Yeah, well, that market, of course, over the course of 21 and 22 was hit quite hard. Housing prices have been off by more than 20% from their peak. It's an interesting housing market, New Zealand, compared to Australia. One of the things, of course, they don't have in New Zealand is stamp duty. And it means that the transaction costs are a lot lower in New Zealand when you're buying and selling compared to Australia. And it just makes me wonder whether that was one of the reasons why we had such a correction, because it was easier for vendors to downsize potentially to get out. That may well have been one of the reasons for it. Rents, of course, have been picking up in New Zealand. And I've also discovered in that housing market that building costs, funnily enough, are actually higher in New Zealand compared to Australia. And the reason why, well, twofold. Firstly, of course, New Zealand's a bit of an earthquake region, so they've got to have their buildings at a higher standard than what we have in Australia. But second, New Zealand has to import a lot of their raw materials, and actually a lot of those materials come to Australia first, so they're importing from Australia. So building costs went up exponentially, so just like Australia did, but from a higher base. So that's affected in terms of the supply side for rents. But even so, yeah, we've had quite a significant correction. And let's not also forget that the New Zealand government brought in some pretty heavy restrictions in terms of foreign investment from about 2018 as well. So when rates went up, and they went up a little bit more aggressively in New Zealand compared to Australia, the average home loan lending rate actually has gone up towards 9%. That's naturally affected the market too. But I think for 24, we should see that correction come to its end. I think there were some leading indicators suggesting that was occurring in the later half of 23. Let's keep in mind that not everywhere in New Zealand's had a major correction. Indeed, one city which has basically beat the correction is the Queenstown housing market in the southern island there. That's actually performed remarkably well.
That's so interesting. You should do a report on it, Louis. There's demand.
Well, let's just say there's a lot to report on in the Australian housing market, and there's a lot of very good local experts in New Zealand. So, SQM's not ready to take on that space yet.
Yeah, when I was writing about New Zealand, there was this advert that was going around that was being marketed to the Asian market, saying, go buy New Zealand, there's no stamp duty, there's no land tax, it's a speculator's paradise, because this was all pre-COVID, a couple of years, 2-3 years pre-COVID. But yeah, and then of course, we got politicians that put in place restrictions on foreign purchases, and I think they also penalised foreign investment, through higher taxation. I think they had talk about vacancy taxes and everything.
I wouldn't be surprised if the new ACT government, that's the party name, repeal some of that, because the new government in place is more centre right to right leaning, a little bit more libertarian leaning. And I suspect in time they will repeal some of these taxes, keeping in mind that everyone's very conscious of migration. And I've noticed a number of libertarian orientated parties are more focused on, funnily enough, migration restrictions, whereas they've historically been more open, having their economies more open to migration. So we'll see what happens there.
When you're doing your forecasts, Louis, as I said, you have been more accurate than any other data forecasting agency, and more accurate than many mainstream economists that are out there. And it just, I'm always joyous to see it, to be honest, because there's so much rubbish that comes out in the media, particularly from the big banks. I mean, who change their forecasts all the time. They come out with one forecast saying property prices are going to boom, and then the next forecast is that they're going to crash. I mean, it's just like watching a weather forecast, What are the absolute, how do you do it? What are the real leading indicators that you look for? And, when I'm in the market, when I'm obviously searching on the ground, I notice immediately if there's a little bit of a shortage of stock. I notice immediately if clearance rates start to shift even marginally, and kind of notice those changes, and also, what's going on in rents. What is it for you that enables you to put together these forecasts? What are you looking at primarily?
Sure. Well, as your audience might be aware, we come up with scenarios, and I think we're one of the very few forecasters which publish our main scenarios that we consider. We normally publish 4 scenarios and then put our hat on our base case scenario. But to get to 4 scenarios in the first place, we actually come up with a universe initially of, say, 20 scenarios, which we think could play out in the future. And then through probabilities, through doing some quant analysis, through just reasonably testing these scenarios, we end up with our top 4 scenarios. So that's where we start from. I guess we take a top-down approach, what we call a top-down approach, in terms of looking at the big macro factors that can affect the markets and have affected the markets in the past, and then get down to like what we call a bottom up, what's happening on the ground, looking at the various leading indicators. The indicators that I like looking at in terms of giving me that immediate future are definitely auction clearance rates, stock on market, looking at the listings, looking, of course, at other factors such as the rental market, what's happening there. Is there a genuine shortage of real estate occurring? What is the pipeline looking at? And like I said, those macro factors, and one of the things that we got right in 2023 was making a call that we would have a big year in terms of population expansion. And when you look at some of those banking economists and their forecasts that they put out back in 2022 for 2023, well, you'll rarely find any comment about migration. It's like as though they completely overlooked at that. They were all squarely focused on rising interest rates. And within that, they were not taking into account the current inflation rate, that the economy essentially was still running inflation higher than where interest rate settings were, which actually continues to stimulate the economy. Now we no longer have that. Inflation's now lower than where interest rate settings are, which means money is being taken out of the economy. Hence one of the reasons why we're a little bit more negative this year. So these macro factors are critical. We definitely look at global events. And you mentioned up front, looking at what potentially could happen in the Middle East and how that could actually affect our housing market here, which is a very interesting one. And people will say, well, gee, who cares what happens in the Middle East compared to our housing market? There's no bearing there. Well, actually there is. The risk in this is that the current war, which quite frankly has been expanding now, we've got the US now bombing parts of Syria, that continues to expand. And what happens then, the risk is that you have essentially an oil embargo coming out of the Middle East where key travel points are blocked. At the moment, the Red Sea, ships going through the Red Sea, if they're in any way affiliated with Israel or going to Israel, well, they're essentially being shelled at. Missiles are being fired at them. And a number of key shipping lines have decided not to go through the Red Sea. The next risk factor if this plays out are the Straits of Hormuz, which Iran has got a lot of influence over, because that's a passage that runs right next to Iran. Now, we're at a very interesting juncture. Will Iran, in response to the recent US attacks, back down and get scared and say, all right, we don't want the war to expand, or will they radicalize and take it to another level? We don't know. No one knows the answer to that yet, but we're at that crossing point right now. If they decide to be more aggressive, that's where we could see Iran starting to fire missiles themselves directly at ships going through the Straits of Hormuz. Now, if that happens, then we've got a real issue in the energy markets, where we could see a supply shutdown of oil flowing out of the Middle East, similar to what happened in the 1970s. That's a risk. If we were to see that, then you could expect in this country a second wave of inflation. When oil prices, petrol prices go up, then that feeds directly through into the CPI. And it's what happened, of course, when we opened up from COVID and we had the Ukraine-Russia war outbreak. So that's the risk. We see the secondary round of inflation. If we were to get that, that's when the RBA would have to actually not talk about interest rate cuts, but talk again about interest rate rises. And all that could still play out this year. And as mentioned, we're at the crossroads right now.
Yeah, I'm so glad that you pivoted into that, because that was actually my next question. How is war going to affect our property markets here? And you know, I've done, the last interview I did was with David Murrin. I am Jewish. I have friends and relatives and that in Israel. So very connected to that region, watching in horror what is going on at the moment. Very well aware that this is in Iranian war, that those supply lines are directly under threat. And now, of course, that Australia and the US are involved.
It is concerning, Catherine, and you know, notwithstanding the personal situation now, which is just a total tragedy. My concern is that if the US starts coming across as weak, that could encourage these more aggressive players.
Yes.
And that's where then the probabilities rise exponentially of a greater regional war. If some of these more aggressive players who have stated in the past they wish to wipe Israel from the map, they've said that, okay, if they think they've actually got a chance of doing that on this occasion, they may well just go for it. That all said, you've got some more moderate players in the place in the region, such as the UAE, and you've got Saudi Arabia, who want stability and who were, you know, moving towards a wider agreement with Israel before all this broke out. Look, you know, I'm not a political military expert. I'm a property expert. I'm just looking at the risks, and when we see all the information come through, it's obvious the risks have risen exponentially of this wider regional war. Hopefully it doesn't come to that. Hopefully it doesn't come to that at all. But it's one of the reasons why we ran this as our number 2 scenario for 2024.
Yeah, I think it was extremely insightful. I mean, the publication that I run, it's called, you know, Land Cycle Investor. One of the cycles that we look at is the Kondratiev cycle, which is a commodity cycle and a forecast of, you know, it runs over 50 to 60 years. And at the peak of that cycle, it's around 25 years up, 25 years down. At the peak of that cycle, you get a lot of inflation in commodity prices, a lot of wars breaking out over trade routes, over supply lines. And of course, we're approaching the peak of that cycle later in the 2020s, around 2026, 2027. And of course, everything that, we would expect all of this stuff to happen now. So I think your analysis is very astute, and it's fitting in with a lot of experts that talk cyclically on commodity markets. I might send you that interview I did with David Murray.
Yeah, I'd love to read that. That would be
really interesting. But one thing that he did say, because he's been forecasting World War III, and World War III really doesn't start unless China gets involved. And so that's the risk that he's out there saying. He's saying that Australia is underdefended, that Britain is underdefended, that America is looking weak, that they didn't shut down the Russia-Ukraine war when it happened, and obviously Russia has its economy has done well because of commodity prices, over recent years. And so, these things, they just don't happen overnight. They come from planning. So he is really seeing the risks of this. If China, for example, were to move on Taiwan, which also is a very essential market, what's going to happen? What are the risks for Australia? And
well, yeah,
concern
if you
is
were
where
to see
do you invest?
that,
Where do you invest?
you've got a wider regional, unofficial, multiple regional wars occurring. That is certainly a big risk. I've always been concerned that China would move while America is weak. Makes logical sense. But there's always a big gamble in war. It still feels like China's still trying to get all its ducks lined up in order. They'd be well aware there'd be an alliance against them. They'd be well aware it would massively affect their economy. But China's got a massive economy, and they've been over many years building up their military. They've made it their goal. They wish to unify with Taiwan. It is a risk. We don't know if and when it plays out. It's definitely an uncertainty. And who knows when it actually plays out, if it does at all. But it's clear risk. And if it does, well, I suspect housing prices will be the least of our worries.
Well, if they're going to make a move, it's going to be around what's happening right now, because America is looking weak. I think that the risks of it are something we, don't necessarily want to dwell on, but something we have to bear in mind. And yes, I understand what you're saying about the housing markets. When you look back at previous wars and how it's impacted property markets, there are areas that have done well, obviously, if they're exposed to defense and military bases, and areas of the economy that are obviously going to boom under those situations. But yeah, maybe.
Can I just say, Catherine, that I think you're hearing now that we have now had, with the change of federal government since 2022, better relations with China. And so some of these tariffs have been coming down. It's also one of the reasons why we're also a little bit more bullish for the state of Western Australia as well, because the here and now, trade's improving between Australia and China.
Yes. Can I just ask you one final question? I know we're sort of over time, but the other thing that I'm interested in is the transition to a digital monetary system. You must have been following what's going on in the monetary space. You must, sometimes look at the crypto space and wonder what the hell's going on there. Do you have any strong opinions about what's happening? Any concerns about, government oversight and authoritarianism?
I'm more libertarian leaning, though I've always been skeptical about crypto in itself, being very conscious of the wild market that it is, and that's played out with a number of these platforms going under. Of course, they're not regulated. They're still not regulated. Crypto will be with us for some time. I've always been skeptical in terms of trying to work out, well, what's the fundamental intrinsic worth of some of these digital coins? What are their real worth? These are, from a pure investor's perspective, I've always had challenges with. But yeah, I got to say, going all the way back to my trip overseas, one thing that did surprise me was the how cashless Europe's becoming. So the only time when I was asked for cash was actually in Germany. I was able to use our travel card in Austria, the Czech Republic, France, no questions asked, no problems. It was only in Germany where I had taxi drivers ask us for cash and some shopkeepers ask us for cash. And that certainly changed compared to when I was in Europe some years back.
Interesting. Yeah, very interesting. I think the next few years you're going to be extremely busy, Louis, doing
I'm feeling extremely busy right now as we speak, Catherine.
already. Yeah,
I'll offer
already.
you a job soon if you want one.
Yeah, no, I'm very happy. We'll have to talk. Yeah, I mean, I'm pinned to your website. All my subscribers, I'm always talking about they've got to go onto your website. They've got to download your reports. Very grateful that you keep a lot of property data free. I think it's a testament to who you are as a human, that you do that you allow people to access information that they need to access to be able to make, solid investment decisions. And of course, your boom bust housing report remains extremely affordable as well. You don't charge thousands and thousands as CoreLogic does and lock things behind closed doors and, not enable anyone to get to them. So it really speaks to who you are as a person and, eternally thankful.
That's very nice of you. It's an interesting path we take here at SQM. We're not owned by any major media masthead. That can be good and bad because there are a number of our competitors which are owned by the media mastheads, and that therefore means that they get the lion's share of media attention. But we are neither are we an enemy of the mainstream media as well. There's a lot of reporters out there who do like to report on us. But yeah, we probably, I think going forward, we're probably likely to move more towards social media because I find that as a very free-wielding, independent space, which is what I generally like to enjoy.
Yeah, and everybody should follow your Twitter account, which is growing nicely, but full of very
it is a social media account I like to hang out. I've generally stayed away from some of the newer media accounts. Maybe we should be doing more on the newer ones. I don't really put much on LinkedIn at all. But with Twitter, or now as it's known, X, I like to debate from time to time, as long as it doesn't get out of hand.
Yeah, I do. I enjoy the debate on there as well. I haven't really dabbled around in many of the others. I certainly haven't done anything on TikTok yet, but I do.
No, I don't know whether TikTok's really good for us X generation people, but I just failed to see myself doing a TikTok dance. I really do.
Some people have risen to great fame through doing TikTok, so it does have its uses.
It does. That's true. That's what a number of key people at SQM tell me.
Anyway, I will let you go. Thanks so much, Louis. It's just an absolute pleasure having you on. Thanks very much.
Nice to be with you once more, Catherine, and appreciated the conversation. And I hope your audience gets something out of that today.
Yeah, I'm sure they will.